this week, this is going to be kind of a whistle-stop tour, this one. I'm going to probably move these to monthly so that there's a lot more in them, so that I don't pull people onto these calls and have them there just for a little bit of time. So I'm going to get you into the agenda as per the email that I sent you. I know someone's already posted a question. I can't actually see them when I'm doing the agenda bit, so just bear with me. If it's something urgent, one of the other guys will probably text me, no doubt. So here's the agenda of things that we want to just try and run through tonight. Tax deferral options, what's available to businesses, general business costs and the obvious shift and changes that we're seeing, the 24-month rule for those that are working on or off-site with individual clients, and then Q&A, just anything you guys want to bounce past me. Clearly I'll try and answer. If I can't for any reason, then I will defer and come back to you either individually or en masse. So where are we now? What taxes have the revenue said, or have the government said that we can defer? So the first obvious one is VAT. If you were trading and operational and VAT registered back in March, certainly probably more Jan through till March to be more specific, you had the ability to defer your VAT. Now, you didn't have to do anything, you didn't have to elect, you didn't have to say anything, didn't really have to do much. You could just park that money in your business bank account and use it as cash flow right the way through until the 31st of March 2021. Now, the only thing to be mindful of here is we still have to file the VAT returns. Don't for 1 minute think that it's just a free passage to leave this and run it all the way through till then. What will happen if you haven't filed VAT returns, Revenue and Customs will chase you for the VAT returns, and if you haven't filed them, they'll make a summary assessment of what they think you owe. Now, invariably, being the revenue, that summary assessment will be either based on previous track record, previous trading history, or randomly made up, and most obviously in their favour. Now, none of that's a problem, because you can then retrospectively file a VAT return and rebalance everything, or ultimately, if you just ignore it, nothing much will happen at the moment because the revenue has too many other things to focus on. But what you don't want is them assuming that you owe them VAT money that you don't owe with a summary assessment, and then charging you interest penalties, and worse still, sending bailiffs round, because the VAT man has the power, has the ability to knock on your door and ask to seize goods to the value of the VAT bill that you owe. Don't expect that to happen at the moment. Again, as I say, I think they've got more things to worry about. But just be mindful, if you haven't filed, file. If you have filed, hang on to your money, but absolutely deadline yourself, put it in your calendar to make sure you pay it by the 31st of March. Anyway, laboured that point enough. Personal tax, you've probably all read that the POA, payments on account, are being allowed to be deferred. There's a payment that's now going to be due at the end of July for anyone who's had personal tax through the course of their personal tax return, higher rate taxpayers, dividend income, rental income, and pretty much anything else that you may have had all the way through the year. Now, normally what happens with a payment on account, for those of you that don't know, you're almost prepaying your tax in advance, and you do that every January and every July. So if, for example, you're assessed for tax and you owe £10,000, you would probably pay £10,000 over the course of 2 payments. So 5,000 in January, 5,000 in July. At the moment, the revenue have said that if you don't think you can afford to pay that, you don't have to notify them. You can just simply, very much in line with the VAT above, almost park it in your personal bank account, cash flow yourself, and then make the following payment in January. Just be mindful that, taxes are there, taxes won't go away, and this is something that will still be payable, be it now or in the future. That leads me on to time to pay. So in the event you feel that for any reason you've got taxes that are accrued or accumulating, both personal or corporate, then the revenue are opening their doors a little bit more to something called time to pay, which is TTP. It's quite an arduous process to normally get through the hoops with Revenue and Customs, because they want to see your in-cycle egg measurement, all of your income and expenditure, and then you tend to have a fairly horrible phone call with them to talk through why you can't pay, when you will pay, and how they can get their money out of you. Ordinarily, pre-COVID, pre-financial doom, the revenue would often want you to pay any monies you owe back within a 3-month period, unless there were very good reasons why you couldn't pay it back, and then they would be agreeable to discuss. The longest time to pay I think I've ever come across personally was over a 3-year period, and I don't know how on earth we managed that. I sort of brokered the deal with the revenue, but again, we were very lucky. We got away with, I think, £500,000 worth of tax spread over 3 years, but that's a very unusual case. In the event you are about to do this, what I would certainly recommend is have a chat with us before you engage in conversations with the revenue. Simply so that we can set our stall out, look at the financial details, and then you don't end up flustered on the phone, because they will still ask you, what's your profit and loss? What was your turnover? What expenses have you got? Why can't you pay the money? What's impacted you, notwithstanding COVID? Now, clearly, if you're in a business such as retail, hospitality, you wouldn't even have to bat an eyelid. They'll just have to concede that you were told by the government to close your doors, so you cannot carry on trading. And in all other sectors, the revenue will still probably want some information. If you want more details on that, just again, drop me a line, and we can talk through the sort of typical things they will ask you for, and then we can almost help you out with a call. One thing to note, because these are taxes that your business owes, or you as an individual would owe in this instance, we're not allowed to do the phone call directly for you. We can step in and help if you believe that you're not in a position to be able to deal with things. So, for example, the particular chap I mentioned with the £500,000, he wasn't in a particular stable mind position to be able to have a conversation on the phone due to deaths in family and all other things. So that's the reason we stepped in, and I stepped in to help him arrange that deal. Typically, the revenue will want to deal directly with the taxpayer or the person that has a fiduciary duty and responsibility for their company. So that's the director of the limited business. So here are the contact details. So if you are needing payment support for the business, this is something you can do. You can phone them and just ask for time to pay, some sort of structured arrangement where you spread the payments to the road over a long period of time. And for the self-assessment, again, you don't need to phone these if you are utilising the VAT deferral or the payment on account deferral. You don't need to phone to get approval first. But these are the numbers if you think it goes beyond that, and you are in a position that financially you think you may be suffering and maybe not able to pay the amounts that are due over and above those two. Now, changes in expenses, very obviously, if you're in lots of sectors, so let's look at them. So, if you're a car dealer, if you're running a petrol station, or if you're dealing with anything to do with cars and servicing, you're probably on your knees at the moment because you're not able to run a business properly and nobody's using their cars. From your perspective as a business owner, you're clearly not claiming mileage. All of these here, for these particular issues, things like train travel, Oyster card, what I would say is please don't claim these if you've got them as a recurring cost going through your business. I know I bang on about this quite a lot to everyone. If they're recurring, please turn them off for now. What it would be inappropriate to do is just roll your accounts along in the same way that we've got a normal year, claiming the typical expenses for going to and from a place of work if they're just standard recurring costs. If we're not doing it for now, deactivate them and flip them into other expenses, which I'll come on to. I think the reason we're suggesting that is revenue and customs are going to have to start coming back and clawing back tax liabilities and tax receipts as we go through and past COVID-19. And some obvious ways to do that will be using algorithms to plug into accounts to look at tax and look at everybody. And if they can see things that are very obvious that are a recurring cost of, let's say, for example, train travel, if it's £2,500 a year and it carries on being £2,500 a year, they'll know full well that you probably haven't been travelling into London or to other places on a recurring basis. So again, just be mindful, deactivate things that don't come and bite you in the bum. What we are seeing is people replacing things like mileage, train travel and Oyster with a lot of home office costs. Clearly people are having increased broadband, beefing up their systems at home. Me personally, I've had to go and buy a Wi-Fi box because my Wi-Fi out here in the sticks is dreadful. So in order to try and boost signal and have signal just in different places when it goes down, or if I need further bandwidth, little Wi-Fi boxes, very good. You normally get sort of 50 gig for not more than sort of £20 a month. But the beauty of that is, again, it gives you the mobile office walking around rather than being sort of rooted to one place in the house or the home. Other home office kit, obviously we're all having a huge change of work environment. So if you do need desks, chairs, filing cabinets, home printers, the Wi-Fi stuff, charging stations, all of those things, they're completely allowable. They were before COVID-19 and even more so now, because you need to be in a position to deliver your work and carry on operating without causing any issues. And what I would say is a lot of people have come to us and said, can I put a lovely log cabin in the back garden and use that as my home office? And the answer to that is yes, but again, there's always caveats behind that. So yes, you can do it, but then you've got to be mindful that if ever the revenue came back and said, is that your home office, or is that your home, or is that your office? You could end up with a lot of issues, either with capital gains tax upon selling part of your property. If you then had a significant building in the grounds that was deemed to be a separate unit, that could cause issues with the valuation and then passing it on. If the revenue or local rental ratings office were particularly narky, they could then deem that it's a corporate asset, which would then mean that it's a rateable unit. Clearly in the here and now, that's actually a benefit, because you could claim small business rate relief and get up to £10,000 contribution. But clearly that moment in time has passed. The reality here is, if you are thinking of doing something like that, let us know. What I wouldn't be doing is putting extensions on the back of the house, really adding capital value to your property and then pushing that through directly into the business, because that would cause a conflict, because that's your private residence, your principal primary residence in many cases, and that's adding value to it. And then when you go to sell it, you may have claimed costs for your company, which have had tax relief on them, which again causes the conflict. So again, just to be mindful, if you are doing anything at home, think about it, let us know, and we can look at the ways to structure it. Now, leading on to sort of 24-month expenses, I talked about this last time a little bit, and this is more for people that are traveling to different sites and different locations. So if your contract or your business in any particular location, and this is geographic based, so if you work on London, which is an easy one for me, 25-mile radius. If you're travelling into that place of work, being 25-mile radius London, if you have a contract in there and then you step out of there, sorry, the joys from working at home. I'm just going to cancel this. Sorry. Okay. I can claim part of my phone bill, by the way. There you go. That's another one. Anywhere that you're travelling in temporarily, that's deemed as a temporary work location for up to 24 months. If the length of a contract or an engagement or a piece of work that you're doing exceeds 24 months, if it's an uncertain contract that's temporary and it stays below 24 months, then again, that's still fine to claim. If you've got a contract or something that you're doing that is deemed to be over 24 months, but then you haven't been claiming travel and subsistence, or the length of the contract is shortened, changed, or messed around with, then the long and short of it here is, as long as you don't claim the cost for site to site, so from your temporary, from your home office location to your temporary work location, including train, travel, mileage, day-to-day subsistence, food and drink, bits and pieces, as long as you don't exceed 24 months, then you can continue to claim those costs if it is deemed a temporary work location. Now, the confusing part here is the revenue suggests that that should be no more than 40% of your day-to-day work in terms of a normal working month, normal working year. So you shouldn't be traveling to a fixed location of work for more than 40% of the time. So if you had home office, location in London, location in Leeds, just to choose different locations, as long as you weren't spending more than sort of 40% per time in each place. I know that's obviously 120%, so you'd probably be looking at 30, 30 and 40 in different locations. Then you would still get a qualified to claim the cost of the site-to-site travel and location expenses. Again, let us know if you've got any issues with that. This is very much based on the contract, so this is why I've added this part in here. So if you do have something that is a significant change, the obvious one we're facing at the moment is being stuck working at home and not going to different locations. That would, for me, be a significant change in your engagement. With a view of that, that means you can reset the 24-month clock. My point here would be that if you do have contracts of contracts for services or delivery that you're engaged in, go back to the end client, the agent, or the people that you're working with, ask them to amend the contract so it clearly stipulates your current work location being home office. The benefit of doing that is you have then not broken the contract, you've just changed the location so that the 24-month rule kicks in all over again. So in that example there, if you've been working for JP Morgan in Canary Wharf and you've been doing it for 20 months, you'd only have 4 months left on your contract and therefore 24 months left on claiming your day-to-day expenses. If you've got them to amend the contract and flipped it so that you're now working at home, it's significant change in my opinion, and I think everyone's opinion, and therefore the 24-month rule will kick back in again. I think that's probably about it for me in terms of things to talk through today. So I'm going to stop screen sharing, and then I hope if you've got any questions, please do let me know after this once I've stopped sharing. Right. Okay. Okay, so no questions at the moment. Okay, well, if that's the case, I will let you all go and have your dinner, which would be great. What we're going to do, so next week I'm probably going to do another one of these. I'll let you know, depending on themes. If you've got content you want me to run through, just shout and let me know. The week after that, we've got a client who's doing an artificial intelligence webinar, which I think is probably much more up the street of a lot of techie people that we have on the call. So I'll probably get you all invited into that one. There's no charge involved, so if you wish to attend, please do. Obviously, if you don't, then don't. And then I think what we'll then do is we'll flip Drinks with David probably to the first week of July. Everyone's welcome. The only rules are cameras on for that one, drinks in hand, and as per the last one, random dogs walking across the screen and doing other crazy things. So, you know, as I say, if you've got any themes you want me to cover off in these events, just shout. But if you have no questions, I will let you go and enjoy your evening. And thank you for being here. Take care, one and all.